The Fed's latest consumer credit bombshell. Americans just slashed credit card debt by a shocking $71 billion or 5.5% annualized rate. But here's the twist. As private banks pull back on lending, creating a massive structural fracture in our credit system, the government steps in to fill the void. Is this the silent depression's next chapter? Let's get into it. We did get the latest G19 report from the Fed. Here we're looking at that. These top two sections are an annual rate. They take the month and annualize it out. We can see for the month of August, revolving credit or credit card debt decreased by 5.5%, again on an annualized basis. Now, non-revolving is growing, but at a slower pace than June and July. If we look at the flow, that equates to a $71.5 billion reduction, deleveraging in revolving credit. Now, this can occur two different ways. Either consumers can pay down the balance, or they could default. And we'll get into the charts in a second to look at what it might be. Non-revolving growing at about 75.9 billion, again, at a slower pace that is decelerating. So here we're looking at the total amount of revolving credit, $1.3 trillion. And of course, that percent change on an annualized basis, 5.5%. But as you can see, there is a tremendous amount of volatility. So we're going to take a 12-month moving average. We can see that is running at 2.6% growth. It did hit a peak here of about 14%. So consumers are still growing their credit just at a slower pace. But for the month of August, we could see, of course, that very, very significant deleveraging. Now, if we look at retail sales here in red, revolving credit or credit card debt, we can see has a pretty good correlation to retail sales. So this is why this stuff is important. So percentage of banks tightening their credit card standards, this has been declining from a peak of about 36% down to just 10%. If we look at the interest rate on credit cards, this is squeezing the average American. We can see currently 22% average interest rate for revolving credit. Now, moving on to delinquency rate and the charge-off rate for credit cards, we can see the charge-off rate is running at 4.17%. And I drew a line here so you can compare that to, say, the 90s or the early 2000s. It is certainly higher than we were post-GFC, but is not nearly as high as we were, say, in the early 2000s. Now, the delinquency rate is only running at about 3%, and both the charge-off rate and the delinquency rate have declined, but we're only looking at quarter one data. We don't have quarter two data yet from the Fed for these two metrics, so we'll have to watch that. But if the past two quarters are any guide, the deleveraging that we were just talking about is probably due to paying down the balance and not taking on new debt rather than charge-offs, unless, of course, we get a trend change and both of these delinquency rate and the charge-off rate start to move higher again. Now, the rate of change of charge-offs, we showed this in the silent or stealth recession video, the 13 charts. Here we can see a spike in the rate of change of charge-offs over a 6-month period of time, which is normally correlated to a recession going all the way back to 1990. And it is just starting to go negative, which should indicate a early business cycle sort of signal, but we will have to wait and see whether or not that plays out. Here, we're looking at personal interest payments per person divided by the average hourly wage. And I keep pointing this chart out, 107 hours per person must be worked each and every year just to make the interest payments on their various debt. And we can see the last time it got up to 105, 110 hours, that level directly preceded the dot-com recession and the 2008 Great Financial Crisis. Then down here, I threw on personal savings as a share of the M2 money supply, a 3-year moving average, and the current account as a share of GDP. Remember, the current account, the main component for the US at least, is the balance of trade. It's our massive trade deficit, mainly driven by a goods deficit. We do run a slight services surplus, but here we can see that current account as a share of GDP is very, very tightly correlated to personal savings for the average American. And hopefully it makes sense that, when you run a twin deficit, as America does, by definition, the only asset that you on a net basis, kind of zooming way out, the only thing you can really accumulate is debt. And as the current account deficit got worse, the trade deficit got worse. Of course, we started running larger fiscal deficits as well. As that got worse, we can see that personal savings, it ended up trickling into personal savings as well, because by definition, the US is over consuming by running a twin deficit. Now, here we're looking at total consumer credit. So, again, this is only slightly positive at about a 360 million annual rate. Now, again, if we take a 12-month average here, we can see it is growing at about 9.7 billion on a 12-month moving average basis, which is right in line kind of with recent history, say post 2008 and going really all the way back to 2000. Now, here is that total revolving and non-revolving credit for consumers. We can see $5 trillion. Now, down below, we have a 6-month rate of change and a 12-month rate of change of this white line. And what I wanted to point out is over the short term, we can see an inflection upward. Again, generally you see this in a recession or immediately following a recession where this goes negative. The rate of change of total consumer credit, that rate of change goes negative and then starts to rebound. Again, that is an early business cycle indicator. Now, if we look at the 12-month rate of change, it is basically right at 0%. But again, on a shorter time frame, we can see an inflection upward, meaning that total consumer credit is starting to grow again over the past 6 months at a 2% rate. Now, here is that total consumer credit on a logarithmic scale. And what I want to point out is that if you go back to 1950 and draw a trend line to what consumer credit was growing at, it's not a perfect trend line, but I think it's pretty close. This gap here that we can see, of course, following 1990, following .com, and definitely following 2008, the gap that ended up resulting, if we had kept pace with the lending, the private bank credit creation, the lending rate that we had coming out of World War II from 1950 all the way up to 1990. Again, some of America's best growth and best economic strength came during this era. Well, if we had kept that rate of consumer credit growth, that translates to a $15 trillion gap between what we're at now, $5 trillion, and what it should be at. Now, down here is an annual rate of change and then a 5-year average of that annual rate of change. And again, you can see coming out of World War II, here in 1947, total consumer credit was growing at like 40% annualized rate. The 5-year average here in 1948 was about 16%. If you go to the peak here in 1950, over the prior 5 years, so from 1945 to 1950, consumer credit grew at a 30% annual rate. Every year, consumer credit grew 30%. And of course, you can see that this moving average hopefully helps to illustrate this rate of change has been declining for a long time, kind of peaked in the late 1990s and has been declining ever since. Right now, that 5-year average is only 4%. And of course, there's volatility, as we can see, with the annual rate of change generally going negative. The rate of change goes negative either in a recession or immediately coming out of a recession. Now, here are two other ways of calculating kind of this private bank credit creation. Remember that the vast majority of the dollars in our system were created by private bank, not by the government, not by the Fed, not by the Treasury, by a private bank. This is Richard Werner's private credit creation theory, and I've done full in-depth videos going through some of his academic research that proves this. But about 90% of the dollars in the system came from a private bank. And here we can see, again, a logarithmic trend rate of growth for both total loans and leases, which is in white, and total bank credit, which is in orange. And again, the gap, if we had kept pace with the 1950 up through the 1990, if we had kept pace with that growth rate, we're talking about somewhere between 35 and 40 trillion dollars of missed, I guess you could say, credit. Now, remember, one man's credit is another man's debt. And so there are two sides to this coin. But of course, down here, we can see the annual rate of change. This has been decelerating, going all the way back to the 70s, private banks, as we can see from the trend line up here, I will remove total bank credit here so you can see just total loans and leases. You can see that this clearly something broke in 1990. Private banks pulled away from lending, and then in 2008, they pulled away even more. Overlaying the other one here, total bank credit, we can see the same exact phenomenon. And again, if the private bank is driving 90% of your money printing, of your credit growth, and they start to pull back, well, something has to fill the void. And sure enough, here we can see what that is. Here we're looking at M0 money supply divided by M2, or the share. And of course, we can see that it was declining. What this meant is during that time period, M2 money supply was growing faster than the M0. Now, as a brief refresher, M0 is bank reserves created by the Fed and currency created by the Treasury. And we can see that private banks were driving credit growth for as far back as the data goes, from 1960 all the way up until, again, 1990, where that trend changed. And of course, the government started to create more money than private banks were. We can see the white line really increase, really sharply increased during 2008. That was really when things severely broke. The same is true with M2 money supply as a share of GDP. Again, we were getting more GDP than we were printing money for this entire period of time. But then something broke, maybe in 1990, maybe in .com. Different metrics show kind of different breaking points, but we can see that we have been printing for prosperity and getting ever less GDP. Our money supply has been increasing at a faster rate than our GDP. And the same is true if you look at debt, government debt held by Federal Reserve banks as a share of GDP. Again, the average here was about 4%. Well, we are now at 15%. So that is a notable increase. Something clearly broke in the early 2000s, maybe even as far back as 1990, depending on how you look at it. But what I wanted to point out here is we're getting an inflection upward in the rate of change of M2, the blue line, M2 as a share of GDP. What this means is that the rate of change of M2 is starting to outpace GDP, meaning we might be starting to get a credit impulse, which again would be an indication of early business cycle. We can see that the 12-month rate of change just ticked positive, currently 1.6%. So the blue line is increasing at a 1.6% annualized rate. What that means is M2 money supply, they're firing up the money printer, you could say, and M2 money supply is starting to outpace the actual GDP that we're getting. So this is typically what you see kind of early cycle, and generally means that there is a pretty hot amount of economic activity coming, maybe some inflation, of course. So anyways, hopefully that was helpful. I will link the G19 report in the description if you would like to read it, and I will catch you on the next one.